Forget the aircraft carriers in the Taiwan Strait. Forget the fighter jets and the grand military parades. If you want to understand the true timeline of the coming global conflict, you must stop looking at what governments show you and start looking at what they hide in the ledgers of sovereign debt. Right now, a financial burn notice has been issued, and the mainstream media is too busy chasing headlines to read the footnotes. The US Treasury Department has just released data that confirms a terrifying trend. China is dumping US debt at a speed that defies standard economic logic. This isn't a simple portfolio rebalancing. This is the second largest economy in the world, clearing the decks for an irreversible divorce from the American financial system. When a superpower sells its rivals' debt at a record loss while simultaneously filling its bunkers with gold, oil, and grain, they aren't looking for a return on investment. They are looking for survival. Today, we dissect the $688 billion exit, the moment the smart money decided that the US dollar is no longer an asset, but a hostage. The latest Treasury International Capital (TIC) report is typically the most boring document in Washington, but the latest figures are nothing short of a catastrophe for the dollar's hegemony. As of late 2025, China's official holdings of US Treasury bonds have plummeted to $688 billion. To the uninitiated, that sounds like a massive number. In reality, it represents the lowest level of Chinese ownership since May 2009. We have effectively erased 16 years of financial integration in a heartbeat. To understand the gravity of this, look back at 2013. At the peak of the symbiotic relationship often called Chimerica, Beijing held over $1.3 trillion in US debt. They were the primary financiers of the American deficit, buying the bonds that allowed the US to keep interest rates low while Americans bought cheap Chinese goods. That closed loop is now shattered. China has liquidated nearly 48% of its position from its peak, but the how and when are more important than the how much. Throughout 2024 and 2025, the U.S. bond market suffered a historic drawdown. Bond prices were depressed and yields were volatile. Anyone selling during this window was realizing a massive financial loss. In asset management, you don't sell a losing asset unless you are desperate for cash or you believe the asset is about to become toxic. China isn't desperate for cash. They have a massive trade surplus. They are selling because they believe the US Treasury bond is no longer a store of value, it is a strategic liability. The lessons of February 2022. The catalyst for this mass exodus isn't hard to find. It started in February 2022 when the US and its allies froze $300 billion of the Russian central bank's foreign exchange reserves. It was a financial nuclear strike that shocked Beijing to its core. They realized that their $1 trillion plus in US assets wasn't wealth. It was a kill switch that Washington could flip at any moment. If China moves on Taiwan, or if the South China Sea heats up, their treasury holdings instantly turn into a donation to the US Department of Justice. By selling now, even at a 20% loss, Beijing is saving 80% of its capital from a 100% total loss tomorrow. This is sanction evasion on a grand, strategic scale. The Bagholder Alliance. If China is dumping hundreds of billions in debt, why hasn't the market collapsed? Because as China steps out, the US is forcing its allies to step in. Look at the TIC data for the United Kingdom and Belgium. The UK's holdings have surged to record highs of $750 billion, despite the UK economy being a fraction of China's size and running a trade deficit. This is not a free market decision. This is financial conscription. Washington is essentially telling its G7 partners that they must absorb the Chinese sell-off to prevent the US bond market from breaking. The West is cannibalizing its own balance sheets to keep the system afloat, but this strategy has a fatal flaw: capacity. Unlike China, the UK and Europe do not have an infinite surplus of real dollars earned from manufacturing. They are buying on borrowed time, and when their currencies or voters revolt, the bid of last resort will disappear, materializing wealth from paper to physical. The most telling part of this investigation is what China is doing with the cash. They aren't buying euros or yen. They are engaging in the most aggressive commodity hoarding campaign in modern history, the golden pivot. The PBOC has been a relentless buyer of gold for nearly 2 years straight. Gold cannot be frozen by the SWIFT system. It has no counterparty risk, energy security. They are filling their strategic petroleum reserve to its 1.5 billion barrel capacity. They are building a buffer that allows them to survive a naval blockade for months, if not years. The Metal Mountain. China is hoarding copper, cobalt, and lithium at record levels despite a domestic housing slump. Why? Because you need these for a war economy. For munitions, drones, and grid resilience, calorie sovereignty, China now holds 60% to 70% of the world's global grain reserves. They are trading paper yields for survival. The conclusion for any rational investor is simple, yet terrifying. For 40 years, the 60-40th portfolio, 60% stocks and 40% bonds, was the gold Harek 8 active investa. Bonds were the safe haven. That era is officially over. The US Treasury bond has been weaponized, and the world's largest manufacturer is walking away from the table. China is methodically, deliberately removing itself from the US financial jurisdiction. They are willing to take a massive loss today to ensure they cannot be strangled tomorrow. The stability you see in the market right now is artificial. It is a house of cards propped up by political pressure on the G7 allies. So we have to ask, if the ultimate insider of the global manufacturing world is selling everything to buy gold, oil, and grain, why are you still holding the paper? Are you waiting for the pivot, or are you waiting for the collapse? The divorce is finalized. The assets are being moved. We are just waiting for the first shot to be fired. The $688 billion exit isn't just a number, it's a warning. Are you listening? They didn't just tap the brakes, they pulled the emergency lever. While the financial news networks are distracted by the stock market's daily noise and the political circus in Washington, a catastrophic signal just flashed in the precious metals market. The Chicago Mercantile Exchange, the entity that effectively controls the global price of silver, just executed a midnight massacre on traders. In a move that stunned the trading pits, they hiked margin requirements by nearly 30% overnight. This is the financial equivalent of changing the locks on the doors while the house is burning. But you have to ask yourself, why? Why now? Why would they intervene so aggressively when the price was simply finding its fair market value? They will tell you it is to reduce volatility. That is a lie. The truth is, the silver market is undergoing a fundamental mutation that the central banks and bullion dealers can no longer control. The paper market, the world of futures and derivatives, is trying to suppress the price to maintain the illusion of a strong dollar. But the physical market, the real world of industry and manufacturing, is screaming that there's nothing left to sell. We are watching the breakdown of the silver pricing mechanism in real time. The spreadsheet says one thing, but the empty vaults say another. Today, we expose the data they are trying to hide. Let's look at the forensic evidence of this crime scene. We need to strip away the jargon and look at the raw mechanics of what just happened. The CME Group issued a notice updating the performance bond requirements. To the average person, this looks like boring administrative paperwork. To a veteran trader, this is a weapon. Until just a few hours ago, if you wanted to hold a standard 5,000-ounce silver futures contract, you needed to post approximately $25,000 in maintenance margin. That was the cost of admission. But overnight, that requirement spiked to $32,500. That is a $7,500 cash call per contract. Think about the mechanics of that. If you're a hedge fund or a large trader holding 1,000 contracts, you were just handed a bill for $7.5 million, payable immediately. If you don't have that cash sitting idle in your account, and most traders don't because capital is meant to be deployed, you have only one choice: you must sell. This is a mechanical maneuver known as a liquidity squeeze. The market makers know exactly where the pain points are. They know that the market is long. By hiking the margin, they trigger a wave of forced automatic selling. Traders aren't selling because they believe silver is overvalued. They aren't selling because the fundamentals have changed. They are selling because the exchange put a gun to their head. This creates a cascade. The price drops on the chart. The technical indicators turn bearish. The weak hands get washed out. The media runs headlines about a silver crash.
But this drop is artificial. It is a paper event. It has nothing to do with the reality of mining geology or industrial demand. In fact, while the price was dropping on the screen, the premiums for physical bars were rising in the real world. This divergence is the smoking gun. It proves that the price you see on your screen is no longer a reflection of value, it is a reflection of leverage. To understand why they are so desperate to crush the price right now, you have to understand that the silver market you knew 10 years ago is dead. It is transformed into a completely different beast, and the old rules no longer apply. For decades, silver was viewed primarily as a monetary metal or jewelry. It was a cyclical asset. If the price got too high, people would sell their silverware, investors would liquidate their coins, and supply would flood back into the market to cool things down. That dynamic is gone. Today, the silver market has been hijacked by the green revolution and the AI boom. We are witnessing a transformation from recoverable silver to consumed silver. The solar panel industry, or photovoltaics, has become a silver vampire. To achieve the net zero targets set by Western governments, the world is installing gigawatts of solar capacity every month. Solar panels require silver paste for conductivity. There is no substitute that offers the same efficiency. Here is the frightening part. When silver goes into a solar panel, it is effectively gone forever. It is not melted down and resold next year like a gold ring. It is locked away on a roof for 20 to 30 years. It is consumed. The industry is now eating over 150 million ounces of silver a year, and that number is growing exponentially. The AI revolution is adding fuel to the fire. Every high-end server, every complex circuit board needed for artificial intelligence requires silver. The CME margin hike completely ignores this reality. You can print more paper contracts to sell. You can hike margins to force speculators out, but you cannot print more industrial conductivity. You cannot margin call a solar panel factory. They need the physical metal to operate. This has created a structural deficit that has lasted for 3 consecutive years. We are burning through the above-ground stockpiles at a rate that is mathematically unsustainable. This brings us to the data point that terrifies the bullion banks, the vault drain. We need to look closely at the COMEX warehouses. There are 2 categories of silver in these vaults. First, you have illegible silver. This is metal that is sitting there, owned by someone, but it is not for sale. It is just being stored. Then, you have registered silver. This is the metal that matters. This is the inventory that is actually available to be delivered against a futures contract. This is the collateral that backs the entire pricing scheme. The registered category has plummeted. We are down nearly 70% from the highs of a few years ago. We are operating on fumes. When the CME hikes margins, they are not just trying to lower the price, they are trying to stop traders from standing for delivery. They are terrified that if the price stays high, sophisticated buyers, perhaps acting on behalf of industrial giants, will stand up and say, "I don't want the cash profit. I want the 5,000 ounces of metal delivered to my warehouse." If that happens, the exchange defaults, the game of musical chairs ends, and everyone realizes there are 100 paper claims for every single bar of physical silver in the vault. The margin hike is a desperate attempt to keep the music playing for just a little bit longer.
Now, we must layer in the geopolitical accelerant. This is why the supply shortage is unsolvable and why the US market is bleeding. While the West plays financial games to manage the optics of inflation, the East is securing the physical supply chain. We have to talk about the Shanghai Premium. This is the most dangerous number in finance right now, and nobody on CNBC is talking about it. For months, the price of silver on the Shanghai Gold Exchange has been trading significantly higher than the price of silver in New York or London. At times, this premium reaches 10% or more. What does this mean? It means there is a giant vacuum cleaner sucking physical bars out of the West and moving them to the East. It is basic arbitrage.
Traders buy the cheap silver in New York, the silver that the CME just smashed down with their margin hike, and they put it on a plane or a boat to Shanghai. They sell it there for a massive profit. The result is a one-way flow of strategic assets. The U.S. banking system, by suppressing the price to protect the dollar in the short positions of the banks, is inadvertently subsidizing China's industrial dominance. China controls over 80% of the global solar manufacturing supply chain. They know they need the metal. They're happy to let the CME smash the paper price. Every time the price drops in New York, China thanks the Federal Reserve and buys more physical metal at a discount. This is not just a trade, it is a transfer of wealth and national security. The U.S. has the paper contracts, China has the metal. In a crisis, you cannot build a missile guidance system with a paper contract. You cannot build an energy grid with a margin call. The West is selling its family heirlooms to pay the rent, while the East is buying them up to build the infrastructure of the next century.
So what is the conclusion for the investor? How do you position yourself when the market is rigged against you? First, you must recognize that the CME margin hike is a sign of weakness, not strength. It proves that the price discovery mechanism is broken. If the market were healthy, they wouldn't need to change the rules overnight to force a sell-off. We are approaching a binary event. Scenario 1. The price of silver is finally allowed to rise to its true equilibrium, likely triple digits, to incentivize new mining production. Scenario 2. The physical market completely detaches from the paper market. We will see a phenomenon known as unobtainium. You will see a price of $30 on your computer screen, but if you call a dealer to buy a bar, they will tell you there is none available, or the real price is $100. The divergence between the spot price and the physical reality is widening every day. The margin hike was an attempt to close that gap by force, but it will fail. You can only hold a beach ball underwater for so long. The deeper you push it, the more violent the force when it finally shoots to the surface. The market is transforming from a casino of paper speculation into a battlefield of physical scarcity. The margin hike is the noise. The vault train is the signal. Do not let them shake you out. They want your silver. They want you to panic sell so they can cover their shorts and ship that metal to Shanghai. The spring is coiled, the industrial demand is voracious, and the vaults are emptying by the day. Sit tight. The real price discovery hasn't even started yet.
It finally happened. The red line has been crossed. For a decade, it was just sanctions. It was diplomatic pressure. It was covert operations in the shadows. But today, the United States government stopped asking nicely. Nicolás Maduro, the president of Venezuela, is in U.S. custody. But while the mainstream media is obsessing over the politics, the international law, the diplomatic fallout, they are missing the real story. The story that is flashing red and green right now on the trading terminals of Wall Street, London, and Shanghai. Look at the silver chart. In a market that was supposed to be asleep, silver just ripped upward by nearly 3.5% in a single session. That is not a normal trading day. That is a violent, vertical wake-up call. Gold is chasing it, breaking $4,400, but silver is outperforming everything. Why? Why does the arrest of a South American leader trigger a massive panic buy in a conductive metal? Because the market knows what the politicians won't admit. This isn't just an arrest. This is a declaration of economic warfare. The safe haven trade is back with a vengeance. The illusion of stability is gone. And when the world's most powerful military decapitates a sovereign government, the smart money doesn't buy dollars. It buys the only thing that has no counterparty risk. Welcome to the new volatility. Welcome to the silver shock. To understand why silver is exploding, we first have to understand the magnitude of the chaos we just stepped into. This wasn't a random event. The detention of Nicolás Maduro creates an immediate, catastrophic power vacuum in one of the most resource-rich nations on Earth. Venezuela isn't just a failed state, it is a mineral vault disguised as a country. For years, Venezuela has been a client state of the East. China has poured billions into infrastructure there. Russia has sent military advisors. They have been using Venezuela as a forward operating base. By arresting Maduro, the United States has effectively severed the head of that operation. The markets hate bad news, but they fear uncertainty. Is this a coup? Is it a restoration of democracy? Or is it the start of a civil war that will lock down the Caribbean shipping lanes? Investors looked at this chaos and realized that the global order is dead. If the rules are dead, then fiat currency, which is built on trust in those rules, becomes vulnerable. That is why the algorithms triggered the buy orders. At 9 a.m., the news broke. By 9:05 a.m., the flight to safety began. And leading that flight wasn't the US Treasury bond, it was silver. So what happens tomorrow? Do not expect this to blow over. Do not expect the price of silver to stabilize. The arrest of Maduro was the stone thrown into the pond. The ripples are just hitting the shore now. The market has moved from a state of efficiency to a state of emotional distress. We are entering an era of extreme price swings. A 3.5% move in a single day might become the new normal. We could see 5%, 7%, even 10% intraday swings as the geopolitical situation deteriorates. If you are an investor, you need to understand that the spot price you see on your screen is struggling to keep up with reality. The paper market is trying to suppress the price, but the physical demand, driven by fear, is pushing it up. The question isn't, did you buy? The question is, do you have the stomach for what comes next? The game has changed. The era of cheap, stable silver is over. The era of scarcity and volatility has begun. And don't blink, because the price action we saw today is just the beginning. Let's dig into the numbers, because what silver is doing right now is historical. Usually, silver moves on industrial news, manufacturing data, solar panel demand, tech output, but today, silver is behaving purely as monetary metal. This 3.5% spike is what we call a fear premium. When geopolitical tension hits the red zone, large institutions deleverage. They sell risky tech stocks and they park capital in hard assets. But why silver specifically? Why is it moving so much more violently than gold? Because silver is the high beta version of gold. It is gold on steroids. When the fear is real, silver moves faster, harder, and with much more volatility. The arrest of Maduro signals to the world that the US dollar is being weaponized to its absolute limit. If you are a foreign nation or a foreign central bank, holding dollars suddenly feels like holding a liability. So you diversify. You buy metal. This 3.5% jump is the sound of capital fleeing the traditional banking system. The supply chain panic. Now look at the industrial side. This is where the volatility gets dangerous for the tech giants. We are already in a structural silver deficit. The world consumes more than it mines. Now throw in a massive geopolitical shock. If Venezuela falls into civil unrest, if shipping lanes in the region are contested, the cost of moving commodities skyrockets. This creates industrial panic. Companies like Apple, Tesla, and Samsung operate on just-in-time inventory. They don't have vaults of silver. When they see silver spike 3.5% on a headline like this, their procurement departments start to panic buy. They need to lock in prices now before silver hits $50 or $60. This creates a self-fulfilling prophecy. The panic creates demand. The demand drives the price up. The rising price drives more panic. We are watching the beginning of a commercial short squeeze driven by geopolitical fear. The China factor. And don't forget the silent war between the US and China. China has been hoarding gold for 18 months. Now, watch them accelerate their purchase of silver. If China believes the US is cutting off their resource colonies in South America, they will vacuum up every available ounce of physical silver on the London and Shanghai exchanges to protect their manufacturing base. They are preparing for a blockade. The Maduro arrest was the signal that the blockade has effectively begun. This massive buying pressure from the East is colliding with panic buying from the West. That is a recipe for explosive volatility.